Say all the very best for your examinations for November exam, November 2011. During the post-class period, some students have just raised some doubts on certain problems. One such problem which was asked in November 1997. See, that point of time, we never had this AS3 cash flow statement. At that point of time, they've just asked something on group fund flow statement. So one of the students has asked me to just solve the problem as group cash flow statement. Strictly speaking, it is neither falling under AS3 nor under AS21. But having asked this question as why don't you solve a group cash flow statement by a student, I just felt it would be nice to take up not one problem, two problems. Firstly, to start with, it's problem number 1. So as far as this question is concerned, we will put it in our website on PDF format. You may just go through that. Now, we will concentrate on the solution. So before we could do that, let me just read out that problem. Question number 1. This problem was asked in November 1997. See a final. I think it was the very first question there. The balance sheet of A Limited as on 31st of March 2010 and the consolidated balance sheet of A and its subsidiary B on 31st of March 2011 given below. They are given you as on 31st of March 2010 a separate financial statement of A Limited and by 31st of March 2011 consolidated financial statement. Rupees are given in lakhs. So further information, A had acquired 75% of equity shares of B Limited on 1/9/2010. At that date, assets and liabilities where they given you information regarding the net assets of the subsidiary company. A Limited, the parent, paid 500 lakhs to acquire the shares in B Limited, 75% of the capital. This was made up by way of issue of shares valued at 437.5 lakhs. Balance was paid in the form of cash. The security premium on the issue of shares stood included in the reserves. Depreciation charge in consolidated accounts amounting to 125 lakhs, asset building 25 and asset plant and machinery 100 lakhs. A Limited paid interim dividend of 50 lakhs on 1/3/2011 and on the same day, B Limited also paid interim dividend of 25 lakhs. Prepare group cash flow statement. It's okay. So the original problem did contain the information regarding fund flow. As a student requested that why don't we solve this under cash flow? Then I thought we can take up the problem with alteration with the dates which would be very close by to your examination. So now this is the first problem that we will take up. Now, how do we take up this problem? I would just explain it in one go. The first and foremost thing that we have to do is with respect to the first item on the asset side, that being goodwill, which is appearing only in consolidated financial statement. So quite naturally, this would be the difference between the cost of investments and the parent's net worth or parent's share in the net assets of the subsidiary company. The first working is like that, computation of goodwill. So we are trying to confirm that the first item on the asset side, that being goodwill, is arising on account of eliminating investments as part of consolidation process. So this information regarding fixed assets, stock, debtors, cash, term loan shown in the negative sign. Creditors also, the net asset coming to 600. 75% of 600 works out to 450 and the cost of investment being 500. We have paid more. As parent, we have paid more. The excess amount is the one that we refer to as goodwill. Now we understand as how goodwill is worked out there. Then how to solve the problem on cash flow statement, and group cash flow statement is no different from that of separate financial statement cash flow statement. That is, for an individual enterprise, as how we prepare cash flow statement, the same way we would be preparing cash flow statement for the group as a whole. So we understand in the group consolidated financial statement, the one what they are given as minority interest as 175. So as on the date of acquisition, date of acquisition means 1/9/2010. The minority interest by then would be different from that of minority interest as on the date of consolidation. So the difference in the minority interest is the share of minority interest in the increase in the net assets of the subsidiary. Subsidiary, since acquisition, that is, after parent acquiring majority interest in subsidiary, subsidiary also would have worked and would have generated some amount of profit. Minority will share on that profit, and the difference between the minority interest as on the date of acquisition till the date of consolidation is the share of minority interest in the post-acquisition profit of the subsidiary company. This is what we have got to understand who this working. Now let us just show that. Minority interest as on the date of acquisition 150. How come we had this figure of 150? If you look into the balance sheet, we understand that net assets of that subsidiary company being 600, and for parents share it is 450. Naturally, the difference between 600 and 450 is the minority interest as on the date of controlling acquisition. Whereas what do you find in the balance sheet, I mean in CFS is 175. The difference is on account of minority share in the post-acquisition profit of the subsidiary company 25. So remember that we would use this information at a later stage. Now, we understand that equity share capital of CFS being 675, which would have only parents equity share capital 675. What they had at the time of the last balance sheet when they prepared it was only 500. So that increase is on account of the equity capital issued as part of purchase consideration to buy that 75% interest in B Limited. Purchase consideration of 500, in which equity share capital and security premium was paid to the extent of 437.5, and the balance was paid in the form of cash. And in that 437.5, equity share capital constituting 175, the balance amount towards security premium. This security premium is included in the total reserves and surplus consolidated figure as on the date of consolidation. The balancing figure is towards cash paid towards purchase consideration. Then I was just referring about this reserves and surplus consolidated figure, in which you would be having firstly the opening balance containing, then the security premium which were generated on account of issuing the purchase consideration. Then for minority interest, there was some 25 rupees increase that you have seen. That would have flown or gone only through consolidated profit and loss account. And they've also mentioned that both parent company and subsidiary company had declared interim dividend. So as far as the interim dividend is concerned, with no information regarding the source, we would only understand that interim dividend was paid only out of post-acquisition profit, because the details regarding as the source and all that they are not mentioned, and we have considered all the net asset as on the date of acquisition as capital, and when interim dividend was paid, it is assumed for want of more information that it was paid out of post-acquisition profit. So, and the balance amount is the profit earned by the subsidiary company and the parent as a whole. So, this parent's earning is for all the 12 months, and the subsidiary's earning during the post-acquisition period from 1/9/10 to 31/3/2011. So 850 to 62.5, this 25 was a deduction that they have made. So therefore, we are showing it with negative sign. Dividend also would involve debit to profit and loss account, in that A had paid 50, and what B had paid was 25, on which 75% of 25 has come back to parent company. It is neither an outflow for the subsidiary nor an inflow for the parent when you are preparing a single consolidated financial statement. So what is being paid to minority interest alone, we would consider that being 6.25. How this 6.25 is arrived at is 25 is the interim dividend paid by subsidiary, and minority interest portion is 25%. Profit earned is only the balancing figure. How do you arrive at as a balancing figure 143.75? You may use a calculator. So on 1175, please deduct opening balance, deduct security premium, add back minority interest, add back 50, add back 6.25. So if all these items were adjusted that way, the amount of profit what they've earned by the group as a whole would be 143.75. Okay, now let us just know about the changes in working capital items, especially stock, debtors, creditors. Stock. So parent company had 275 at the beginning, and as part of the acquisition process, they got some stock. So this stock may be lying at the close. So there are two alternatives available before us. Either this amount of stock can either be deducted from the closing stock, or it can be added to opening stock so as to find out the changes. So any item of asset bought other than by cash cannot be included as part of your cash flow statement. So therefore, from the normally what we do is that closing stock minus opening stock, we find out the changes. If the change were to be plus, it would mean that you have paid or money got applied. And if the closing stock were to be less than the opening, that means to that extent amount got liquidated, which will amount to inflow. Whereas in this case, some amount of stock, what you hold at the end, were influenced on account of acquisition that you have made, and that amount of subsidy stock is included in your closing stock. So in order to pull it out from your closing stock, we can as well include it under opening stock. In any case, opening stock will be deducted from closing stock so as to find out the changes. So here what we are doing is that we are adding it to the opening as if it was an acquisition happened at the beginning, but instead of deducting it from the closing, we are doing it as a matter of convenience by adding it to the opening. So 275 plus 75, 350, closing stock is 375. That means you can consider that 75%, 75 rupees increase is an outflow, therefore it is shown with negative sign. That is 25 is shown with negative sign, which is an outflow of cash. 375 minus 350, not 75. Let us 225, 100. This 75 and 100 are the acquisitions from subsidiary company as existed on 1/9/2010, that is on the date of acquisition. 325, 420. So clearly debtors figure is much greater than the adjusted figure. The increase is to be considered as an outflow of cash. So creditors 275, 200, 475, and at the end 600. The difference between the two is an inflow. To that extent of cost we are not paid. So this information we may be using it when we prepare this cash flow from operating activities. And the same thing we got to do it for fixed assets also. So land and building 650, and land and building on which depreciation could be 25, and 675 is before depreciation. Plant and machinery where you have 1617.5, and plant and machinery 100 and 1717.5. So this being the figure before charging depreciation. 2392.5 is the gross block of the item of land and building before charging depreciation, as the depreciation involves no cash outflow, but we have deducted it from our fixed asset. So opening balance of land and building and plant and machinery given in the problem we have taken up, and plus whatever we have acquired, the same thing what we have done for stock data, same thing is done in this case also. 1900 could have been the figure. The difference between the two should be considered as an increase purely on account of cash paid to the extent of 492.5. So cash flow from operating activities. What are the items that we are expected to take up? So the profit, what they have earned, is that we have got to add back depreciation and add back that is deduct towards what I would say for stock and debtors changes, and add back changes in creditors. So these are the things that we are expected to do. So 143.75 depreciation, changes in stock, debtors and creditors all put together comes to 273.75. So cash flow from investing activities, fixed asset bought, that is bought by cash, not bought by cash, 492.5. Purchase consideration paid. In the total 500, 437.5 was paid in the form of equity shares and security premium. The remaining amount 62.5 was paid in the form of cash. Only that much will be taken up in cash flow statement. 555 outflow, and next one is cash flow from financing activity. There is only one outflow, that being interim dividend paid by the parent to their shareholders and by subsidiary to their minority interests. So 56.5. Now whatever we have seen for operating, in investing and financing, if you sum up, what you just get as net decrease, that comes to 337.5. How come 273.75 minus 555 minus 56.25, all that comes to 337.5. So opening cash and cash equivalents, opening they had 150, upon acquisition they got 125 and 275. Say, understand that it was net decrease. So from 275 positive balance, there is a fall to the extent of 337.5. So 275 minus 337.5 should give you the closing balance. So closing balance was also arrived at by taking up cash and bank overdraft 62.5. And that is the end of the show as far as this problem is concerned.